Hey everyone, and welcome. Today, we're going to break down a process that honestly keeps the entire financial world from falling apart. We're talking about reconciliation. It sounds complicated, but really it all boils down to one simple, crucial idea: making sure the numbers actually add up.
You know that feeling, right? That little jolt you get when you log into your banking app. You were so sure you had a certain amount of money in there, but the number on the screen is telling you a totally different story. That little moment of panic, that's exactly where we're going to start.
Well, believe it or not, there's a name for the process of solving that mystery. It's called reconciliation. And it's really just a simple three-step dance. First, you check two different sets of records. Second, you figure out exactly where they don't agree. And third, you go in and fix it. This simple process is, no joke, the bedrock of all financial accuracy.
Okay, so when we say two sets of records, what are we actually talking about? In the world of finance, it almost always comes down to a classic showdown between two key documents.
So on one side, you have the ledger. Just think of this as your personal version of the truth. It could be your spreadsheet, your old checkbook, or for a big company, their internal accounting books. It's what you think is going on. And on the other side, you've got the statement, which comes from an outsider, like your bank. That's their version of the truth. And the whole game, really, is to get these two stories to match up, down to the very last cent.
Now, in a perfect world, these two records would always be identical, like a perfect mirror image. But, as you know from your own bank account, they often get out of sync. So why does this happen? Let's play detective and look at the usual suspects, especially in the big leagues of financial markets.
It's easy to assume that a mismatch means some kind of huge error or that someone's trying to pull a fast one. But the reality is often way less dramatic. Most of these disconnects are caused by totally normal, everyday financial stuff. And the most common reason of all? It's all about timing.
Yeah, the financial system, for all its power, just doesn't move at the speed of light. Money and assets don't just teleport instantly. And that creates a completely natural and perfectly normal lag between when something happens and when it gets officially recorded everywhere.
So you get this temporary information gap. For instance, let's say a big investment fund buys a stock. They'll mark that down in their own records, their ledger, immediately. But the official record keeper, a custodian bank, won't update its books until the trade officially settles, which can take a few days. During that little window, the two records are going to disagree. It's not an error, it's just a predictable difference that will sort itself out, but it's still a difference you absolutely have to track.
All right, so reason number one is timing. The second major culprit behind these mismatches comes directly from the companies themselves. We're talking about something called corporate actions, which are basically events that can change a company's financial DNA in an instant.
The key thing to get here is that the official external record, the bank statement, often gets updated before the internal one. So, a company does a stock split, bam! The new shares show up on the custodian's statement first. A company pays out a dividend, bingo! That cash lands in the official account before the client even has time to log it. In all these cases, the two records are temporarily, but correctly, out of sync.
Okay, so we know why things get out of whack. The big question is, how do these massive financial firms actually go about fixing it? Well, the process usually falls into two big buckets. Basically, checking your own homework and checking your homework with a partner.
You can see the two flavors of it right here. First up, you've got internal reconciliation. This is all about a company checking its own work, making sure the trading desk's numbers line up with the accounting department's numbers. It's about keeping your own house in order. And then you've got external reconciliation, which is what we've mostly been talking about. That's when two different companies, like a hedge fund and its bank, compare their books to agree on one final absolute truth.
Now, let's bring all of this high finance talk right back down to earth, back to where we started, your personal bank account. Because it turns out that process you go through to double-check your balance, it's a perfect miniature version of what the pros do every single day.
Just think about it for a second. That check you deposited that you're still waiting on to clear, boom, that's a timing issue. That tiny bit of interest the bank paid you or that monthly service fee they took out, those are like corporate actions. They're outside events that you haven't put in your own records yet. And of course, there's always the possibility of a simple typo. When you check your account, you're literally doing what the pros do. You're comparing your ledger to their statement to find and fix all these little differences.
So in the end, that's really what this all boils down to. It doesn't matter if we're talking about a couple of bucks in your checking account or billions of dollars in a global investment fund. Reconciliation is the essential, non-negotiable process of creating one single agreed-upon version of the financial truth. It's what builds trust and, frankly, makes the entire system work.
When you get right down to it, reconciliation is just about aligning two different versions of reality to find the one single truth. And if you think about it, that's not just a financial thing, is it? We do it all the time. Aligning our expectations with a partner in a relationship, or comparing a project's goals with its actual progress. It really makes you wonder, doesn't it? What's the most important reconciliation you need to make in your life right now? Thanks for tuning in.